Welcome back to Financial Thought Exchange from the CFA Institute Research Foundation. For those of you just joining us, I'm Larry Siegel, your host, and our very distinguished guest is David Booth, the founder and or co-founder of Dimensional Fund Advisors, one of the most successful investment management firms of all time, and probably the first factor investor. It's been around for about 44 years. David, we were discussing some of the personalities around the University of Chicago, the discovery of efficient markets and not so efficient markets, and your role in this soup. And I think we had gotten up to where your firm had been operating for 9 or 10 years, and that you had underperformed. You outperformed your benchmark, but the benchmark had radically underperformed. And so how do you survive? And as I remember, you also got into some other factors besides small caps. It was value. And then you developed a formula for marketing your firm's services in conjunction with, am I saying it right, financial advisors?
Yeah, yes.
And that was unique, and drove you into the first rank of investment management firms where you hadn't been before. Can you give me some color on this?
Yeah. So we set up our strategies, our funds for institutional investors. Back in those days, it's still pretty unusual for institutional investors to commingle, to go into commingled funds.
Right.
So that was the first part that was unusual. But what made those funds particularly attractive is the low fees. You know, if you're selling to institutions, you have to have low fees. So a financial advisor in Sacramento took a look at this and go, holy cow, here's a way of beating, the regular index funds and the fees are low. I'd like to invest. So he comes to our offices. Rex and I met with him, and he was incredibly larger than life figure. And he persuaded us to give him access, his funds, his clients to our funds. And we said, we're not sure we want to have individuals in the funds because we read about individuals as they're in and out, and we can't have that. He goes, oh, no.
They trade a lot, and they also may have expectations that are not realistic.
Yeah, right. Which is why they trade a lot.
Right. Yeah, that's exactly right.
Yeah. So we gave him access to the funds. A year later, he comes back, says, I think there's a business in this. Working with, there are a lot of fee-only advisors.
What's his name, by the way?
Dan Wheeler.
Okay.
So Dan came back and he said, I think there are a lot of advisors out there like me. And we said, okay, well, we'll give it a try. Until people don't realize this, but until that time, basically nearly all mutual fund houses started as load fund houses. I don't know if anybody started as a true no load.
I don't either, and I was about 14 the first time I bought a mutual fund, and you give them $100, maybe. I think it really was $100.
Well,
And your NAV, your net asset value, the moment you give them the $100 is $91.50.
yeah, right.
Ouch.
Ouch. So we said we didn't. So we're not. But that was back in those days. That was the fee-only financial advisor was a teeny tiny part of the industry because it was still dominated by wirehouses and so forth. Those are the people we felt good about. I mean, the financial services industry is fraught with conflicts of interest. So we said, okay, but we'll put up some guardrails here, Dan. We can't just let anybody come into these funds. So what we did is we set up a 2-day introductory conference, which if you wanted access to our funds, you had to come sit through that 2-day conference at your own expense. No trips to Honolulu or anything like that.
Okay. Fair enough.
And so it was self-selection, but if people were willing to do that, they were probably biased towards believing what we had to say. And it developed a good working relationship. And it turns out what was a small idea to begin with has eventually grown, and now it's It's a bigger part of our business than the institutional side.
Yeah.
And
How big is the business overall?
we manage about 800 billion, and a little over half of that is with the financial advisor.
Well, that's a great story. Let me shift gears a little bit. I believe both of us started out at a place called the University of Chicago Graduate School of Business, and at this time, many decades later, we both say we went to Booth. How did that happen?
Oh yeah, well that's really kind of funny. You know, I often tell people the stories about how as an undergrad I put myself through school selling shoes. And I can guarantee you when I was on that fitting stool, I never had no idea how life would change for me. And it really changed with going to the University of Chicago, my graduate school of business. As we've talked about earlier, I just had this incredible experience. Kind of one of the things that was going on at the business school was finance workshop. They would meet weekly, and professors and PhD students would present papers to each other, and you kind of got to know the faculty well. And Roger Ibbotson and I presented a paper on. We thought fantastic, but anyway, we developed this great relationship with the faculty. Then when we went to start the business, the first phone call I made was to Gene Fama, asking him to be a founder of our firm and a director.
Mhm.
He was really in charge of building up our research team. And then the independent directors, Merton Miller, Myron Scholes, and then eventually Jack Gould, George Constantinides, and Abby Smith. I'll just stop there because I'll forget somebody if I don't.
Yeah,
Um,
sure. But it's an
uh,
all-star cast here.
yeah, all-star cast.
Most of my finance professors are
Yeah, right.
a nice group.
And 5 of these directors we've worked with over time. There's one outlier there, Bob Merton. He had his Nobel Prize before he became a director of the funds. But the other 4, we got them before they were Nobel laureates. Merton Miller used to get a big chuckle about that. And you know what? First thing is, it really did work. They were great at monitoring what we were doing on behalf of shareholders. It's kind of
The
like going back to
professors were,
business school and
yeah,
presenting papers.
right.
You had you couldn't walk into a board meeting and fill them full of fluff. You had to there was a rigor there that you associate with a business school. So as time evolved, my family became financially secure, and things worked out. I thought back fondly on all the help, not only at school, but in following up and helping us start Dimensional. Nick, in the early days, it was really tough to get appointments to talk to people, get sales appointments. And, we would throw out all these names, hoping something would stick and
Yeah.
people would agree to meet with us. And that association with these professors gave us a lot of credibility that we wouldn't have had we just been a startup firm with a new idea. I was the first portfolio manager operating out of my spare bedroom. You know, credibility like that, I don't know how much it helped, but it had to help a huge amount.
Yeah.
So I became financially secure. And so I went in to talk to the dean. Ted Snyder was dean then. I said, Ted, I want to give up a big chunk of what I have to the university. They've always been kind of my partner more than anything else. So think of this, I want to think of it as kind of a partnership distribution. And I gave them a stream of income off of shares of Dimensional, and they put the value of 300 million on that stream of income. So I said, that's what I'd like to do. He goes, hey, we've been thinking about getting somebody to name the school. The school is called the University of Chicago Graduate School of Business, which is a mouthful. We'd like to have a name. We were thinking about having it named. This was a lot more than we were thinking about asking for. So we'll name the school after you. So I said, oh, okay, whatever.
Okay.
And
That was
you
easy.
feel good. And I think
But
finally,
it's not easy to make $300 million.
yeah, right.
It was the largest gift in the history of the university. Is that correct?
I think that's right. Maybe at that time, the largest to a business school anywhere.
It was the largest to any business school anywhere in the world and the largest to the University of Chicago. That's right.
Actually, it turned out to be an answer to a Jeopardy question one day. So, and the answer was, who was the University of Chicago? As soon as that came across, everybody that watches Jeopardy started calling in, you got to listen to this. Anyway, it feels really good. I mean, it's painful giving up a big chunk of your income to the university, but they deserve it. So what the hell?
They deserve it as effectively as your partner, and that was a very good way to put it, a partnership distribution. But also, we, the alumni, now have something to point to that is less generic, explaining what. First of all, University of Chicago students have to perfect a rap that they give. No, we are not Circle Campus.
Yeah.
No, we're not Chicago State.
And no, we aren't a
We're-
place where fun goes to die.
Yeah, we're not. Well, the fun has had a rough time at various periods at the University of Chicago, but it's improved.
It has improved a lot.
It's improved a lot, and the campus has improved a lot, partly thanks to your gift. But yeah, but it's still tough. It's still a tough school. Don't go there expecting to get a straight A average by doing average work. It's not going to happen.
Oh, I had for years that dream that a lot of people have that, I signed up for a course, forgot to go or something, and
Everybody has it. I have it.
know.
Well, when I was in high school, I wanted to go to the University of Chicago because Milton Friedman was there, and then I met him, and eventually thought, well, I better sign up for his class while I'm still in school. And everybody I knew said, "You're going to get a C. That's a good grade." And I thought, well, I don't want to work that hard for a C, so I took the beginning economics sequence from Yale Brosen, who was a kind of a puppy dog, and I got an A without trying that hard, but also a great relationship in my life. Milton Friedman, I believe, would have probably given me a C for very good work.
Well, that ties into a story with Roger Ibbs. So we had done this paper on the relation between money supply and stock prices. So they would present it at a finance workshop, and the finance professors thought it was really pretty good. And so Friedman actually taught a second course, which was called Money Workshop. And what Money Workshop was, it met for 13 weeks and a quarter, met once a week, and it was 13 papers being presented by students. And the price of admission into this class was to have a paper that Milton wanted to read. And even though there was this tension between the business school and the economics department, Milton decided to accept our paper.
Very nice.
And so it comes up time to present the paper. And Milton, if your paper didn't say the money supply changed everything in the world, he wasn't interested in your paper. So when Roger and I presented our paper, Roger has a slightly different take on it than I have, but I thought he was too wedded to his positions to listen to reasonable arguments. And back that night, I started thinking about it. I go, I'm not really cut out to be a professor. Roger and I worked really hard on this, and this is the reaction. And that's just part of, I understand, part of the academic business. But it's not for me. I want to apply ideas rather than do this research. And that's when I walked in the next day into Fama's office and said, I'm out of here. I can't take it. And Fama said, well, I've had this guy, Mac McCown at Wells Fargo, who's wanting to start the first index funds.
Yeah.
I'll give him a call for you. And he did. Mac met me for dinner in Chicago and then flew me out to San Francisco for Wells. And
Yeah.
I started work for him. That's how I got in the business.
Well, that's an inspiring story, and I'd like to spend the last, we had about 6 minutes, or maybe a little more, to ask you what advice do you give to not investors? I think we know that, but to young would-be entrepreneurs in the financial field, people who want to be taking the path now that you started to take in the late 60s, early 70s?
Well, first off, I don't give advice on anything, but I'll share with you some of the things I think that people need to keep in mind. Investing is really about managing uncertainty, and investing is complex and uncertain, but life is complex and uncertain. So people along the way, as they've grown to the point where they want to be an entrepreneur, they've come to grips with how to deal with uncertainty. And a lot of it parallels a lot the ways we think about managing uncertainty and investing. So clearly, whatever it is you need to do, if you want to be an entrepreneur about whatever business you think you want to start, you need to have a passion for it. My daughter went to business school at Stanford, and
Mm.
MBAs at Stanford. They all want to come out and start a business. They don't. They go, that's not what being an entrepreneur is about. Find out something that you have a comparative advantage in doing. You got to ask your question. You know, if you start the business and win, is that what you want? Because you have to be careful. You may end up getting what you want, or you may end up getting what you work for. Secondly, there's a scale. Can you? And fundamentally, being an entrepreneur, why would people hire you for it? I mean, you have all these big, sophisticated firms offering a wide range of services. What is it you have that other people aren't offering? That's sometimes
Well,
people.
that's gotten harder. When you started, there weren't, you didn't have a lot of competitors. Somebody was
uh,
doing something at Wells Fargo and somebody
Yeah,
at Vanguard, but all the big houses were selling stocks. They weren't building portfolios. So that's the revolution that needed to happen. Now there are 1,000 or 2,000 of them.
yeah. Well, no, I think if I were starting, for me personally now, coming out of school,
Yeah.
I would try to think about how to get in the financial advisory business. I think that's going to continue to explode. And I think part of it's because of AI, and with AI and also with the continual secular decline in administrative costs, it's going to be more and more economical to have an advisor. The biggest people need a financial advisor. Just full stop.
Yeah.
Dealing
I
with all
agree.
these issues on their own doesn't make sense. But for many people, the cost of an advisor is too high. And it's not
It is
because they're
high.
greedy, it's just because it's the time cost. If an advisor can figure out how to use technology and so forth so that the personal time is not wasted, it's only focused on issues of that only personalization can accomplish, then they have a chance for a nice business. I would try to be innovative on time efficiency, being the most efficient financial advisor. And that doesn't mean being a robo advisor. People need personalized attention, but you just got to focus your time management in a way that's very effective. So that would be the entrepreneur. That's my best idea for being an entrepreneur.
Well, I like it. As somebody pursuing this that you're aware of,
Yeah, that's been the big change. When we started working with financial advisors in 1988, 89, basically they thought their job was just picking a handful of mutual funds and, you know, picking a portfolio. There's an increased linkage now between what's going on in your personal life, what's going on in your investment life.
yeah.
In fact, we call this connection LIFE, standing for Lifetime Integrated Financial Experience. And
Okay.
and financial advisors are getting better at integrating. Let's say you're getting ready to retire. You're in a different position than somebody that's just starting out. You win the lottery, you lose your job, all have another kid, you get married, you get divorced. All these things can impact your financial decision. And then, of course, what you want to do with your wealth after it, you know, at the end of it all, whether it's to charity, your kids, or whatever you or spend it. All these things are very complex. So anyway, I think that's been the big difference in financial advisors now versus 30 years ago.
I think that that's important because you also have to be a psychologist. I'll just give you a little personal example and how you could have been able to help me at a critical juncture in my life. When I was 55, I quit my job. It also happened to be the generational low of the stock market, which closed at 677. That's the S&P 500, not the Dow Jones. 677 today, it's around 5,700. I had avoided the crash because I sold most of my stocks thinking the market was going to crash. Well, when you do that, you start thinking that you're smarter than you are. And if I knew the market was going up ninefold in the following 16 years, I would have held on to the stocks, but I didn't know that. What I knew was that I was out of a job. So I didn't really get back in. And I'd have a few extra $1 million if I had done that. And that makes a difference. That's a lot of money.
Well,
So what I needed was somebody to bully me because persuasion might not have worked.
well, that's
The
right.
stocks.
Look, we all familiar with, or at least everybody, all the CFAs are familiar with the magic of compounding. You know, you don't have to go spend much time on it. It's true. Compounding is true in life as well. You know, you are the result, the compounding of many decisions you've made over your life. What are the things that have worried you over time? One of the things that still makes me sad is just kind of what you described. Every time there's a market dip, people get stressed out and want to bail out. And then the market goes up and they go, well, now I can't get back in. The train's already left the station, you know? So, if we can figure out how to overcome that human behavior, Danny Kahneman says it's unrealistic to think, people would behave any other way. Well, maybe he's right.
You have to create a structure where it's in their it's in their perceived interest to behave another way. And the way that a lot of people have done it is corporate or government sponsored retirement plans where you put money in and then you're punished severely for taking any out before you're 60 or 70 years old. I think that's helped.
Well, that's right. I think that's a good way to kind of end in this with a note of optimism, where the
Please.
professional financial CFAs can really do a great public service by helping people come up with sensible investment solutions that they can stick with, and if they can stick with these financial solutions, investment solutions, then they'll get the benefit of compounding over time. So I think it's a good time to be a CFA, and I wish I could be around a lot longer to see all the progress.
Well, I think we'll both be around for a little while and see what happens in the next few decades. Thank you, David, very much for your wisdom. And David Booth, chairman, founder of Dimensional Fund Advisors. Thanks. Talk to you soon.
For more information, please visit rpc.cfainstitute.org/research-foundation.